And it's 1:30 p.m. right here in Lagos, Nigeria. Coming up on the program. As the world marks MSME Day, the federal government in Nigeria is set to fast-track single-digit loan access for MSMEs in the country. And new data shows Zimbabwe's annual inflation spiked to 175% in June, up from 86.5% in May. Plus, fewer Egyptians can afford to buy livestock for sacrifice this Eid due to the country's soaring inflation. Hello, welcome to the program. I'm Ladi Williams. First off, let's check in on the markets now, see how it's looking at intraday. Starting on the African continent, we see it's mostly positive sentiment there. The NGX again up at intraday, 0.19%, same as yesterday, and closing in the green yesterday, while South Africa is also up there, 74,000 points, up 0.12%. But in the EGX 30 that closed yesterday, up 2.18%. When it closed for the Muslim celebrations today in Kenya, closed in the negative, marginal, down 0.03%. And it's a positive close for just the Qatari index in the Middle East yesterday. But the Abu Dhabi and Dubai index marginally down yesterday to close. Still within the region there, we see Saudi Arabia is also down about 0.06%, while the Qatari index, that's the lone gainer, closed yesterday, big 2.35% jump yesterday. Let's take a look at what's happening in Europe now. See, Germany's Federal Court of Justice opened the way for more compensation claims against car makers Volkswagen, Audi, and Mercedes on Monday, and that's because they had installed emissions-altering devices in vehicle models. For more now, joining me is Chimponda Chimbelu. Great to have you, Chip. Can you tell us more about this decision?
Well, the decision affects three models from German car makers, Volkswagen, Audi, and Mercedes. They had devices that turned emissions controls off at some points when their car models were being operated. For instance, the devices would switch off when it was really cold, and the car makers had been arguing that they needed those functions to protect engines against damage. Meanwhile, environmentalists had argued that that was illegal because customers were unaware that the emissions controls were being switched off. Initially, the Federal Court of Germany had sided with the car makers. It said that they could only be forced to compensate vehicle owners if they had intentionally installed an illegal device. But the court was forced to revise its initial ruling after the European Court of Justice sided with the car owners in March. So the European Court of Justice said the car makers had been negligent. Now that means that the initial disputes that had been dismissed by Germany's highest civil court will now go back to district courts across the country.
Yeah, quite interesting. But what happens to car owners now?
The car owners in the cases involved in the decision initially wanted to be compensated for the value at which they purchased their vehicles. And while the Federal Court of Justice has now sided with them, it has said that they won't be compensated for their entire purchase value. But they will receive between 5 and 15% of the purchase value. Now, this decision will affect thousands of car owners in Germany and in Europe. We know that there's one law firm here in Berlin which represents 50,000 claimants. So that's a lot of car owners already. And a lawyer at that law firm has said that some of the claimants, that for his claimants, that the court decision will make it easier for them to become compensated. And of course, now the question is whether there will be more car owners coming forward to claim compensation.
All right, Chip, but how's the European markets? How are they looking today?
Well, the recent failed mutiny in Russia has dampened the risk appetite in markets. It showed that geopolitical turmoil remains a major challenge. Still, European stocks are expected to make small gains today, and we will see traders watching a speech by European Central Bank President Christine Lagarde, who is in Sintra, Portugal. Now, they'll be looking for clues as to how much the ECB plans to raise rates in the coming months. And we'll also have some data coming in in, with economic confidence expected from Finland and Italy, and Swedish manufacturing figures also expected.
All right, thank you so much. Watching out for what the ECB does next. Now, that's Chiponda Chimbelu right there in Berlin, giving us the details from Europe. And from there now, let's head on to the UK, still about the supermarkets right now. Juliana joins us right there. Great to have you, Juliana. So the supermarkets in the UK are backing the move for a transparent system of live fuel pricing. But the UK's biggest supermarket chains have defended their grocery prices. It seems the fight against, rising prices is intensifying right there in the UK.
Yeah, you're absolutely right. Good afternoon, Laddie. This all goes back to the beginning of 2023, where the Prime Minister Rishi Sunak set out 5 promises to the UK, and one of the biggest promises he made was that he was going to halve inflation before the end of the year, and that is proving difficult. Whilst a broad-based CPI has come down from some of those 40-year highs where it was reaching double digits, it's still at 8.7%, much worse in supermarkets, where inflation is between anywhere from 14.7% to 25%. And this is really hitting people where it hurts, which is why the big 4 execs from grocers were hauled in front of the Business and Trade Committee of MPs today. So that is bosses from Asda, Tesco, Sainsbury's and Morrison's, and they have been defending their price cuts. And I'm not surprised that they've been defending them, because we've seen them scrambling over the past couple of weeks to try and bring down some of those cost-cutting measures that they're receiving at the wholesale to consumers. Just on Monday, for example, Sainsbury's, which is the second largest supermarket, they announced £15 million worth of cost-cutting measures on basics such as pasta, bread and honey, which is incredibly expensive to buy in the UK at the moment. So they're defending all of their price cuts. Again, I'm not surprised. Tomorrow, the Chancellor will be meeting with the Competition and Markets Authority. They're currently investigating supermarkets to make sure that they're not profiteering. But in any way, it's not a legal requirement for supermarkets to do so. But I think considering, this has now reached geopolitics, this drive to try and bring down prices. Supermarket bosses want to make sure that they're doing the best they can, and the Conservative government want to learn the lessons from what happened with the oil and energy crisis here in the UK, and make sure that the corporates are not benefiting while beleaguered Brits are struggling.
Yeah, and talking about, the Chancellor, he has told banks in no certain terms they must pass on higher interest rates to savers. What are you hearing about this?
Well, this is pretty much the same conversation about, the big corporates profiteering, particularly when it comes to big banks in the UK, the big 5 banks, so that's Barclays, HSBC, Lloyds, NatWest and Santander. I do believe that the Chancellor met with them last week talking about interest rates, because higher borrowing costs, high interest rates and high inflation are key drivers of what's dragging down the British economy at the moment. And we know that British banks and banks across the world saw a decrease in their profitability during the pandemic when interest rates were so low. But they haven't been low for over a year. In fact, since December 2021, banks in the UK have seen their bottom line triple in some circumstances. And even though we know that those who have significant high loans are struggling to pay them back because interest rates are so high, there are still some people in the UK that have a significant amount of savings. And with interest rates being at 5%, the Chancellor just can't get his head around the fact that these big banks are not passing on these interest rate hikes to savers. So I think typically, if you have got savings in your account, you won't see payment on more than about 0.85 to about 1.12%, which is much lower than the base rate. So, again, I think this is just a caution. There is no legal requirement at the moment, but as, Brits are still struggling with the cost of living crisis, anything that can be squeezed out of the corporates that are profiteering from this period, the judiciary are going to take it out from them.
I guess the savers also need to enjoy those rate hikes at this time. But how are the markets looking in the UK?
Well, yeah, the markets, they're okay, pretty much in positive territory. I think we had some breaking news that the Royal College of Nursing, which is a significant union in the UK, looking after the benefits of hundreds of thousands of NHS staff, they did a ballot on whether or not to conduct industrial action. They lost that ballot. I believe 84% of those who took part in the vote voted for industrial action, but it failed to meet the threshold of more than 50% of participants. I believe only about 43% took part in that. So that's a win for the government, and that's been reflected in the markets at intraday. So the FTSE All-Share of the blue chip index is up slightly by 0.01%. The FTSE 100 is up by 0.09%, and the FTSE 250, the domestic market, that's up at intraday by 0.22%. In the currencies market, the British pound is currently trading up against the US dollar by 0.19%. £1 will get you $1.27 at the moment, but it's trading down against the euro, the British pound at intraday by 0.07%, but up against the Japanese yen by 0.37%, Laddie.
All right, Juliana, thank you so much for that update. We'll see you again tomorrow. Thank you.
See you tomorrow.
All right, now let's take a look at what's happening in the U.S. You see stock futures are mostly higher today as investors look forward to the next batch of economic data coming out right there from the U.S. You see the Dow Jones Industrial Average marginally up about 0.06%. The S&P 500 futures is also up 0.19%. And the NASDAQ, tech-heavy NASDAQ, that's up 0.43% at 14,920 points. It's not looking bad in the U.S., but investors still looking out what's going to happen next with rate hikes right there in the U.S. Let's turn our conversation now to root vegetables. See, sweet potatoes is a popular staple. It's produced and consumed and processed across all states in the country. It's considered a substitute for yam. And in spite of this spike in headline and food inflation, the price of sweet potatoes remained flat at $22,000 per bag in the last 3 months. Joining me now is Halima Adediro, analyst, financial derivatives company. Great to have you, Halima. Why this contrary movement relative to inflation in Nigeria? Hello, Halima. All right, we'll try and get Halima back later on. Don't know if she could hear me right there, but we'll take a break. And when we come back, conversations continue right here on the African continent. Just stay with us. Welcome back. Let's get some stories now right here from West Africa. See, the federal government says it plans to urgently ensure quick access to single-digit loans for Nigerian small businesses within the shortest time possible. Vice President Senator Kashim Shettima made this known in a statement to mark the 2023 World Micro, Small and Medium Enterprises Day. Explained that the move is made in recognition of the role of MSMEs in growing the nation's economy. He mentioned that the government remains committed to providing support, fostering an enabling environment, and improving access to finance for MSMEs, particularly as they face numerous challenges due to recent removal of fuel subsidy. And Zimbabwe's annual inflation has surged to 175.8% in June, up from 86.5% in May, according to data released by the country's statistics agency. The sharp increase in inflation highlights the severe price crisis gripping the nation. Additionally, monthly inflation rose significantly by 58.8% to reach 74.5%, reflecting the impact of the steep depreciation of the local currency. The Zim dollar, the Zimbabwe National Statistics, measures inflation using a blended average of prices in both US dollars and Zim dollars, a method criticized for distorting the true inflation picture. And talking about FX, the unification of Nigeria's foreign exchange rates is expected to bring many positive results, including lowering the pressure on foreign reserve. But let's get a sense of how this impacts the stock market, real returns, right here. Joining me is Ibukun Omoyeni, Sub-Saharan Africa economist. Vetiva, great to have you on the show.
Thanks for having me. Good afternoon.
Yeah, so with the recent FX market unification, what are you expecting for FX inflows into Nigeria?
Okay, briefly, our expectation for FX inflows will be guided by an empirical finding. We gathered data and we discovered that FX inflows in Nigeria are basically of two types. We have FX flows through the CBN and we have autonomous FX flows. While the flows from the CBN are driven majorly by dollar inflows from oil, autonomous FX flows are from remittances, capital importation, and other non-government related sources. And we discovered that over the past 13 years, autonomous FX flows contributed about 60% to total FX inflows, while CBN contributes the remaining 40%. And what this means is that since autonomous FX flows are quite dominant, right? So we decided to check how does some macro variables affect FX inflows. And we discovered that FX gap, that is the gap between the official and parallel market, the wider that FX gap, that leads to a reduction in autonomous FX inflows. And that relationship is significant at even 1% level. And what that implies is that there's a 99% chance that if the gap between the official and the parallel market widens, there will be a decline in FX flows from autonomous sources. So given this background, the recent move to unify the FX market, which has led to a convergence in the exchange between the official and the parallel market, is definitely positive for FX inflows into the economy. So that's my take on that, sir.
And I see the CBN has been on, a rate hiking cycle since about May last year. What should be the next move by the CBN at the next meeting to complement this unification drive?
Okay, so to answer that question, we also go back to data. According to our analysis, we saw that real rate of return is positively correlated with FX inflows from autonomous sources. And what that means is that autonomous investors or foreign investors, remittances, and other non-government related FX sources pay attention to, one, the monetary policy rate, and two, inflation rates. And when we try to run the numbers under between 2009 and 2014, between 2014 and 2020, we discovered a very wonderful or slight difference, right? We discovered that MPR and inflation independently influence these FX flows between 2009 and 2014. Or between 2014 and 2022, we discovered that inflation was a major driver for the decline in FX flows. And what that means is that once your real rate of return is not positive, there is no incentive for foreign or investors to bring in their funds. And this has actually affected the FX market, because instead of having attractive real rates of return in the domestic money market, we saw a lot of speculative bubbles in the foreign exchange market. So due to the decision, despite the decision of the CBN to raise rates, we've seen that there's a disconnect between rates, money market rates, and even the MPR. But between 2009 and 2014, there was a connection, right? There was this synchronized relationship between money market rate and MPR. So we think that at the next MPC meeting, there should be moves to, beyond raising rates, there should be a move to return to economic orthodoxy, such that money market rates reflect the monetary policy rates. And that way, we could probably see some inflows into the economy.
And if, inflation, continues to rise at this point, and the CBN, for some reason, stops raising rates, what happens to FX inflows?
So if the CBN stops raising rates, right, and like I said, the issue is not just the rates, right? When we ran the analysis, we discovered that MPR does not significantly drive FX inflows. And this reason is because of the disconnect between money market rates and the monetary policy rates. So beyond even hiking interest rates, what has to be done is that money market rates have to reflect, for instance, right, just if you check out the 1 year treasury bill, between 90 to 364 days, between 5 to 7%, but your MPR is at 18%, inflation is at 22%. There's a disconnect. So why is the MPR at 18% while the 1 year bill is doing 5 to 7%. Now, we understand that, of course, there are fiscal concerns around deficit and all that, but the Apex Bank has a role of exchange rate and price stability, right? So you want to focus on your goals. So the fiscal authorities also have their goals, right? And by the time rates are attractive, right, you might say it stifles growth, but once you have FX inflows due to attractive interest rates, that will reduce pressure on your foreign exchange markets, and that would even pave way for reduced imported food inflation. So I think it's something that we need to look into. Beyond raising rates, there has to be a connection between the monetary policy rates and the money market rates.
Right. All right. Let's look at the equities market now. It has reacted positively to the policies by the Tinubu government. Would the unification continue to have a positive effect or impact on the equities market going forward?
Like we have seen, if you look at the stock market trends for the past, since the inauguration, you discover that the market reacted, or there was a huge jump at 2 points. The first point was when subsidy was removed. The second point was when when FX rates were unified. And it just tells you that the market wants to see those reforms, right? I think the next variable the market is looking at is interest rates. Like I said, it's not just about raising the interest rate, right? There has to be this, although we've seen some moves by the authorities to actually return to monetary orthodoxy, such that we have seen certain moves to remove certain rigidities around the market so that it reflects what the market wants. And once we can achieve that convergence in interest rates, which is actually the next thing, right? There's a disparity, there's a gap in our interest rates. Although we've not empirically assessed that, but I believe that once we are able to close that gap, once the MPR reflects what the money market rates are doing, right? There will be, there was a time when a lot of people in diaspora wanted to invest in Nigeria because the rates were quite attractive. Those kind of returns actually support a lot of FX inflows. I think we need to return to that era, because what we have seen over the past 13 years is, even when we had the oil boom, even when we saw high oil prices, right, autonomous FX inflows were still the dominant providers of FX. So we think we need to return to that, and if we can do that on the monetary side, we believe that some of these goals will be achieved.
All right, we'll definitely be watching out for all of that. Thank you so much, Ibuku Omoyeni, Sub-Saharan Africa economist, Vetiva. Thank you so much.
Thank you for having me.
And soaring inflation in Egypt has resulted in few Egyptians being able to afford to buy livestock for sacrifice during the festival of Eid al-Adha. Traditionally, wealthier Muslims purchase livestock to distribute to meat, that's the meat, to those in need. However, due to the country's high inflation, butchers in Cairo have observed a decrease in the purchase of locally sourced meat compared to the previous year. Local farms have also scaled back their output due to the drop in demand. The devaluation of the Egyptian pound last year led to significantly higher prices, making meat unaffordable for many. Presently, the cost of 1 kilogram of beef is around 370 Egyptian pounds, whereas last year it was half that price during Eid al-Adha. Similarly, the price of 1 kilogram of mutton has risen to approximately 380 Egyptian pounds compared to 180 Egyptian pounds in 2022. The decrease in prices has affected customers looking to buy cows and live sheep, but prices for the live animals rising from 70 to 150 Egyptian pounds per kilogram for sheep, and from 65 to 170 Egyptian pounds per kilogram for cows compared to last year's Eid. And Kenya's central bank has announced an increase in its key interest rate from 9.50% to 10.5% in an effort to control inflationary pressures. This follows a previous rate hike from 8.75% to 9.50% in May. The Monetary Policy Committee acknowledged the ongoing inflationary pressures, heightened risks to the inflation outlook, and global uncertainties and their potential impact on the domestic economy. In light of these factors, the committee concluded that tightening monetary policy further was necessary to anchor inflation expectations. Kenya's inflation rate rose to 8.0% in May from 7.9% in April, primarily driven by increases in fuel, food, and non-food prices. All right, let's try and get back to that conversation now. We have Halima Adediro. Halima, I don't know if you can hear me now.
Yes, clearly. I can hear you clearly, Ladi.
Fantastic. So tell me, why are we seeing those that price, disparity between the inflation rate and for sweet potatoes?
And so what's mainly caused that is the consumption of sweet potatoes. What we could see is that in the last 3 months, the consumption of sweet potato has maintained a flat trend. So which means the demand will not be driven so much because the consumption is kind of stable. So unlike other commodities like maize and cassava, whereby we have their demand being a derived demand, that is, their demand being used for other composite purposes. The demand for sweet potatoes majorly is for direct consumption. So the flat aggregate demand for its consumption has made the price to remain stable compared to other commodities, whereby we have a spike in their prices due to high inflationary pressure.
What are you seeing for prices going forward? Quickly now.
I didn't get that.
What are you seeing for prices going forward for sweet potatoes going forward?
Going forward, we will still see that the price will remain stable for now until we see an increase in its demand over time. But if the demand for sweet potato remains flat in the coming months or in the near term, we'll still see that the price will remain flat or stable for now.
All right, fantastic. We're watching out for those prices. Thank you so much. That was Halima, data analyst, Financial Derivatives Company. Thank you. And with that, yeah, that's the show today. Thank you so much for watching. That's how your money performed. And those are the top stories on the African continent today. Thank you for watching. I'm Ladi Williams. Bye for now.